Thanks for joining us for part 2 of our conversation about breaking down what's happening in the banking industry. Last week, we were joined by Michael Westfall, Director of Investments at Foster Group, who gave us his perspective on what's been happening to financial markets recently and the impact that those recent banking headlines have had on the markets and your investment portfolio. Today, we're going to be joined by Jim Plagge, President and CEO of Bank Iowa. Jim will offer his perspective on what has happened with some of the banks that have been in the news lately, the overall health of the banking industry, and some of the things that consumers should be keeping in mind as they go forward. Jim, I'm sure you've had an interesting few weeks, so thanks for taking the time. So my hope for today's conversation is to give our viewers a bit more context for what's happened the last few weeks, but it's a little bit complicated to unwind. So I think the best place to start would be maybe at the foundational level with just trying to understand kind of how banks operate.
Yeah.
So I think everyone basically understands, as a consumer, we make deposits, checking savings accounts. If we need a loan for a car or a house, we'll borrow money. But I'm sure I'm oversimplifying the process from your perspective. Can you just give us an overview of how banks operate, maybe a banking 101 perspective to start?
I'd be glad to do this. Thank you, Matt. It's good to be here. Yeah, so the main thing banks do is we start by collecting deposits from our customers. We want to bring deposits in from our customers. Those can be in a variety of ways. They can be in the form of checking accounts, which are generally non-interest bearing, savings accounts, which will pay some interest, or CDs. We take those deposits. Generally speaking, banks want to lend out as much of that as possible.
Okay.
We're always going to want to keep some cushion between how many deposits we've gathered and how much we loaned out, because we want to have some cushion for liquidity. But we'll generally try to lend out as much as possible at various interest rate maturities. Some will be variable rates, some will be 3-year variable rates, some will be 5-year, 10-year fixed interest rates, but we want to have a wide spread of interest rate risk there. To the extent that we don't lend out some of those deposits, we will invest them in the investment portfolio.
Okay.
And there again, we'll want to do, ideally you'll want to do a variety of maturities there so that you capture some short-term interest rates, some longer-term interest rates, always have some investments maturing to create more liquidity should we need it. And then we earn a margin on the spread.
Yes.
That's how we make our money.
Makes sense. Is there a difference between how maybe smaller community banks work versus, say, some of those national banks?
Yeah, I think you would, generally speaking, you would say the smaller community banks are going to be a bit more conservative in both the lending side as well as the investment side. There's some very sophisticated interest rate risk modeling systems out there. We all use them to some extent. It depends on whether you have a staff of people running that interest rate risk or whether you're doing it along with your 15 other tasks.
Yep.
Generally speaking, a smaller community bank is going to be more conservative just simply because they're not going to have the sophistication. Being less conservative will perhaps reduce their profitability, but it's also going to reduce the risk.
Sure. So speaking of interest rates, coming out of COVID, we saw inflation really start to rise. And I know the early thought was that it was going to be kind of transitory or temporary. Unfortunately, as we all know, that has proven not to be what has happened the last 12 months or so. As a result, the Fed has been pretty aggressive with how they've been raising interest rates. A little over 12 months ago, the federal funds rate was about at 0, and now it's close to 5. So from a banking perspective, I'm curious, what has those interest rate increases done from your side of things? And has the speed of which they've gone up added to maybe the complexity of having to manage all of that?
They definitely have. And I'll even go back a bit further. At the outset of COVID, of course, when everything was locked down, we were all stuck at home. Nobody could spend any money.
Sure.
So our deposits started increasing there because people were continuing to collect paychecks, but they weren't spending it. Then all the stimulus programs came out, so more money flowed into the banking system. So virtually every bank out there realized a flush of deposit growth.
Okay.
So we all had much more deposits than what we had in the past. So now we had to make a decision of what to do with that money. Loan demand was still good, but do we sit on that money and see if it's going to stay, or do we invest it in the investment portfolio? Most banks invested it in the investment portfolio at a variety of maturities, short-term ranging to long-term. That would be what we normally do. And then the government started raising rates.
Right.
And so now most of us had more investments than what we had previously. So depending upon how long we went out on those investments, that created a real big gap in what the book value or purchase value of those investments were and what the current market value is. That's not a problem as long as you can hold that investment to maturity.
Sure. Yep.
Because you're still going to earn the rate of return on it that you had originally contracted for. But if your deposits are shrinking, as what's happened in especially a Silicon Valley bank, now you need to sell those investments. And with rates going up, they had to sell them at substantial discounts. All of a sudden, their capital position is gone.
Sure.
And the FDIC steps in.
So you talked about the investment portfolio that you have. Can you maybe walk our clients through, like, what do you guys typically invest in?
Yeah.
And how is that then subject to interest rate risk?
Yeah, there's a variety of investments we can do. We can all the way from simple government treasuries, mortgage-backed securities, agency bond issues, agencies of the federal government.
Sure.
All very safe investments, and you can invest all the way from 1 month in maturity to 15 to 20 years in maturity.
Okay.
When rates go up, those longer bonds obviously lose the most market value.
Right.
And in none of the situations where there's been problematic banks have they had a problem with the quality of what they were investing in. They weren't investing them in junk bonds.
Okay.
It was the maturity that they were investing at, and hence the market value decline.
So, Silicon Valley Bank has been the one that's probably
Yep.
gotten the most headlines. You touched on it just a minute ago, but can you explain maybe in a bit more depth, like what happened with them? They
Yeah.
failed. Like, what was the leading cause for that bank failure?
The starting point, they catered to startup businesses, many of which were using private equity funding. And so they had a large percentage of their deposits, I believe it was 86% of their deposits were uninsured by the FDIC, meaning they were greater than 250,000.
Okay.
And they were in relatively small number of hands. So they had a small number of depositors, relatively speaking, with huge balances.
Okay.
So when problems started coming to the surface, such as and then they took those deposits and they were investing long.
Okay.
They've invested extraordinarily long, the way it looks. So there was a mismatch between their funding and how they invested it. And so when some news of their problems started coming out, they lost an extraordinary amount of their deposits quickly. And that created the need to sell investments, and they just simply couldn't keep up with the flow of money out. A traditional community bank would have lots of depositors with modest balances, most of it insured by the FDIC.
Okay.
Assuming it's insured by the FDIC, there's less risk of that classic run-on deposits.
Mm-hmm. So I think, it's interesting. I can fall into this camp sometimes too. When you think about banks or companies failing, specifically banks, I think it's easy to think they were reckless.
Yeah.
They were reckless maybe with how they were investing or with maybe how they were lending. It seems like Silicon Valley Bank was a little bit different than that. Would you agree with that?
Yeah, we haven't yet seen any evidence that there's any credit quality problems. In other words, loan quality problems. Mm-hmm. Most banks who ran into problems, especially during the 07-08 economic downturn,
right,
they had problems because they had credit quality problems.
Right.
So they had a lot of problem loans on their books, wiped out their capital. Again, the FDIC steps in. There's been no evidence of that yet, and perhaps there won't be. Mm-hmm. It was strictly a liquidity. Can they meet the demands for their depositors?
Was all the depositors asking for the money?
They want their money
at the same time, basically. So,
and we live in a very connected world now, so news travels fast.
Yeah, kind of helped with that, right?
Yeah.
Well, it's interesting. We've been talking about the headlines. There was one recently in the Wall Street Journal about how bank oversight failed.
Yeah.
Curious just to get your thoughts on, would you agree with that? Like, was there oversight issues, or what's your general thoughts on that?
There's been a lot of talk about that within the banking industry.
Sure.
Because we all know the supervision we're under. We all know that the modeling and the testing that we do, and we compare that to what we assume was happening at the banks that had problems. There was a clear mismatch of their deposits, the length of their deposits. They were mostly overnight demand deposit checking account deposits, the way it sounds, and how they were investing those. Plus, they were in a large amounts in few hands,
Sure.
So there's a mismatch there. And then, from the looks of it, they were investing long in treasury bonds, which are the safest instrument you can invest in, theoretically. But they were investing long, so there was a mismatch on the maturity. So one would have thought the regulators would have given some guidance there that they're needed, and maybe they're dead, but
Yeah.
it was too little, too late.
So, it seems like, a part of the issue was, again, a number of people coming all at the same time, forcing them to sell things that were, viewed by most, I think, as relatively safe investments, more interest rate risk there. But I've been reading that there's been some changes or a new program that's come out. I think it's called the Bank Term Funding Program.
Yes.
That maybe would have, or maybe will help banks in the future better navigate this type of issue. Is that right?
Yes, it's a little bit unique. Banks have several sources of funding. We can borrow against our loan portfolio, against our mortgage loan portfolio, real estate loan portfolio from the Federal Home Loan Bank. We pledge loans to them for collateral. They'll lend us the money. We can borrow a Fed funds line of credit from the Federal Reserve by pledging securities. However, in all of those programs, they discount the value of your collateral. If, for example, you're pledging investments to the Fed, they will take the market value of that investment and then discount it from there. The new Fed term loan program allows us to pledge those bonds at face value. So and then we can borrow 100% of that amount. So it removes the need for a bank to sell that investment if they need that liquidity. They can get the same amount of money as the face value of that investment by borrowing and meet their liquidity needs. So it's a very good program, very well thought out. And I think it stems the short-term risk of banks having to sell investments.
Right. So if banks maybe didn't match that duration very well.
Correct.
This would allow them to navigate that a bit more effectively.
It gives them a cushion, It gives them the ability to buy some time.
So had that been in place, would there have been a different outcome?
I think there definitely would have been a different outcome for SVB because they could have pledged those bonds at what they paid for them rather than what the market value was. They wouldn't have had to take that loss, which eroded their capital.
Got it. That's good. So you've been in banking a long time.
Yeah.
And I'm sure during, that time period, you've seen a lot of different banking issues, dating back to, I'm sure, savings and loan, great financial crisis. I'm sure there's some things kind of in between there. How does this one compare, if at all, to that? And should consumers be concerned about the overall health of the banking industry?
Yeah. This one is unique because it is truly a liquidity issue, not a quality issue. A quality of either loans or investments is simply a liquidity issue. It's the classic run on a bank, and the erosion of public confidence in that institution. Again, typically it's a credit quality problem. I think the two banks that have failed thus far, very unique. One a crypto bank, one a bank that was catering to startups using private equity or venture capital. So very unique business models. I'm not saying they were wrong business models, but unique business models that presented unique risks that probably the industry wasn't quite ready to regulate, to understand the regulatory risks. I think community banking continues to be safe and sound. One way for you to understand, the quality of the bank you're working with, there's a rating system that's available to the public. Bauer Financial 5-star rating, BAUER. It's not a perfect system, but it does take into consideration the capital, the earnings, the credit quality, any regulatory matters that have come forth because those are public. So it's a good way to capture immediately, the quality of your bank. They rank from 1 to 5, 5 being the strongest. That's a good way. You can also talk to your banker. Don't be afraid to talk to your banker, whether it's somebody at the front line or they will gladly put you in charge with one of the leaders who would also be glad to talk to you. I'm sure we welcome those conversations. Yeah,
that's great. So let's shift gears a little bit to the consumers. So when we think about the consumers at, say, SVB through the bank failure, I think a fair question that a lot of us had when we saw those bank failures is our money safe? And so what happened to those depositors? How did the FDIC step in? What was their coverage amount? And then we'll move into what should consumers think about going forward.
Yeah, so that was the big question over the weekend, 2 weekends ago. What's going to happen to those depositors? Because by then it was pretty well public knowledge that there were a lot of uninsured deposits at that bank. So that was the mystery throughout the weekend, and how the FDIC and the regulators reacted to that was probably going to determine how Monday was going to go. So when they announced Sunday evening that they were going to insure all of those depositors, Part of me was relieved because it was going to certainly reduce the anxiety of Monday morning.
Yep.
Part of me wasn't real happy with that because it effectively rewarded behavior that perhaps wasn't totally appropriate. I definitely have sympathy for the depositors. You know, if you've got an organization, a company, a $250,000 limit, in some cases, that's you just simply you need more liquidity, cash on hand to do that. So, I think in the end, most bankers accepted the decision. There's part of us that doesn't like it, but we accepted it and recognized why they made the decision they did. Yeah.
So as consumers, what should we be thinking about how we structure our own accounts? Maybe just a quick refresher. What are the FDIC limits and how do we maximize those potentially within a banking engagement?
Yeah, so the official FDIC insurance limit is $250,000. However, there's ways to structure those deposits. If you simply have a husband and wife, they can easily get $1 million of FDIC insurance coverage. You can have $250,000 in each of your personal names, just as single accounts, and then you can jointly have $500,000. And then if you have children, you can do payable upon death. You can have trust relationships or trust connects. So there's ways to definitely structure your deposits. Simply go on FDIC on their website. They have links that can tell you how to do it. Or again, you can talk to your bank. They can help walk you through that as well.
That's good. So very helpful, Jim. Any closing thoughts or things you want us to be thinking about going forward?
Yeah, I think the question in the banking industry right now is what are the regulators going to do, specifically the FDIC, with insurance coverage and, again, specifically for businesses?
Oh, might they raise it?
Yeah, might they raise it? I don't necessarily see an increase in the consumer side because, as I just said, there's ways to structure your deposits to get more than $250,000 of coverage.
You bet.
On businesses, I expect there will be some programs coming out, either private insurance that we can purchase, or the business can purchase, or the FDIC coming out, putting together some qualifiers on if you meet these qualifications, you're eligible for more. We would pay a premium on that.
Of course.
Additional premium. The FDIC is an insurance company, just like
anything else.
State Farm Insurance. So they charge a premium for that coverage. That we would be charged a higher premium. But I think that would go a long ways in helping address the problem of business deposits and that $250,000 limit.
Okay, very good. Well, Jim, thanks so much for taking the time today. Very informative and helpful. Hopefully it provides some context and perspective on what's happening within the banking industry. I know at times it can be tough to understand the implication of the recent events and sift through the headlines. So hopefully our conversations with Michael and Jim provided some insights and some things that as an investor and consumer, you should be keeping in mind. And if you have additional questions or concerns about this or anything else, please don't hesitate to give us a call. We'd be happy to help. Thanks for joining us today.